All right, there's a lot going on in the markets in the world right now. For all this, let's bring in Baird Managing Director Michael Antonelli. Michael, good to see you here. Let's start overseas here, because this has been, of course, you have what is happening in the UK with the Queen, but this has been a weird week for international news. Higher rates, new signs of fresh lockdowns in China, yet the U.S. markets seem to be ignoring all this. Why do you think that's the case?
It's great to see you guys again. I think we're kind of underestimating the soft landing notion. It's something that I've been kind of dancing around in my content, or something that I've been dancing around when I speak with clients. If you look at some of the data that's coming in, say just take jobless claims, for example. The 4-week moving average of jobless claims has been falling since August 6th. You've got inflation data, crude oil, gas prices, shipping, freight, all that stuff coming down, used car prices coming down, supply chains easing. I've talked to lots of corporate CEOs recently. Supply chains have gotten much, much better. So I think that the market is sniffing out a kind of potential, or a rising potential, for a soft landing in the U.S. And remember, the world doesn't make the U.S. sick. The U.S. makes the world sick in terms of economic, recessions. So I think that we're kind of underestimating that, and the market's grappling with what does that mean if we do have a soft landing.
And as the market grapples with that, Mike, good morning, by the way. We've been talking a lot about how September tends to be lousy for markets, right? But so far, so good in these markets. Do you think that we're going to continue to have this sort of has the market in the U.S. gotten the Fed's message at this point? And has it priced that message in?
So if you follow me long enough, if we talk long enough, you'll learn a couple things about me. I'm generally pretty optimistic guy. I try to see the brighter side of things. I'm not one of these kind of perma bears. Maybe I'm a perma bull, I guess. The market is taking what the Fed is saying to heart, and the Fed is saying we are not taking our foot off the gas pedal. We don't care if inflation data comes down in 1 month. We are not taking our foot off the gas pedal. And I think that's kind of locked us into a range. We had that really nice bounce, got back to the 200-day, and then just dropped 10% over the course of about a week and a half. And that was the Fed, Jackson Hole, saying we're not done anytime soon. But they have to say that. There's no way that they can hint at a pivot. There's just no way. They have to be really, really firm. The market has taken that to heart. So that keeps us in a range. That keeps us in a maybe 100-point range, 200-point range in the S&P. And the perma bulls are going to be wrong. The perma bears are going to be wrong. And that's going to frustrate a lot of people.
Michael, despite your optimism here, what gets us out of this range? You know what, good or bad? We'll stick with your optimism here. What gets us out of this trading range? What does the markets need to hear when the Fed comes out with its decision in a couple weeks?
They definitely need to hear some sort of commentary about being data dependent and really harping on that point of being data dependent, because as long as they're confirmed in saying that they're not going to stop hiking, that their foot's on the pedal, we're going to need some sort of language about, the inflation data is starting to look promising, something like that, where we're like, okay, maybe these 75 basis point hikes are going to be ending soon, and 375 basis point hikes, my friends, is really extraordinary tightening. That does not happen in history all that often. So what's going to get us out of this range? It's going to take time. I've been telling clients it's going to take time. It's going to take a little bit friendlier language, and then it's just going to take this data continuing to point to a soft landing.
Mike, something you tweeted about recently, you kind of everybody keeps throwing around the word unprecedented, right? And they have been for the past almost 3 years now, as we look at the pandemic, as we look at central bank activity, et cetera, et cetera. And you sort of tried to tease out, is this really unprecedented? And if it's not, what can we look at in history to try and figure out how to think about this period in time? And what's your conclusion, I guess?
Yeah. One of the best things I get to do in my job is I have the opportunity to speak to our clients quite a fair amount. And they have a list of worries. Of course they do. They're humans. They're investing. They're seeing the headlines just like we are. One of the things I like to remind them of is the world's a crazy place. The world has always been a crazy place. So I said, what we're going through now, have we ever seen this before? A pandemic, high inflation, Fed tightening, an energy crisis, shrinking earnings, recessions, geopolitical events. Have we seen those before? The answer is certainly yes. Across the board, we have seen all these before, which means we have a roadmap. There's a roadmap to get out of it. Certainly energy crisis, Fed tightening, all of those have a roadmap to get out of them. What doesn't have a roadmap? Remember 08, a global banking system collapse. What doesn't have a roadmap? A meteor wiping out 4 or 5 major cities in a nation. There's no roadmap for those. What I'm trying to say in the tweet was, we've seen all this before. There is a roadmap. It's going to be tough in the near term, but we will get out of this just like we always have. And people watching the show, I hope you take to heart the fact that the world's a crazy place. If you need some help getting through that, there's always people available.
Michael, I'm not done yet on this Earth. Please, no meteors. I want no meteor prediction. Don't even go there, because I think the market will go down about 80%, right? I think we can agree with that. Maybe more.
Yeah.
Who knows?
Maybe more.
But look, we're also dealing with some commentary and some focus now turning to the midterm elections. You have some members of the Biden administration, like Janet Yellen, out there taking a little bit of a victory lap. That's how the Journal put it this morning on the economic recovery. Should they even be doing that? And is it right to think that the economy rebounds next year?
That's a great question, and they'll certainly be campaigning on inflation coming down if we start to get that data coming down. I bet they'll be campaigning on a soft landing if that data starts to manifest. I don't know. I like to say that the market doesn't really care about elections. It cares more about policies than politics, and then it also cares what are the odds those policies can even be enacted. So a lot of people conflate elections with something that they should be doing in the stock market. And I always remind them that's fraught with danger, that's fraught with peril. What's going to get the economy out of this, I think, is again more time. We're going to have to repair some of these wounds. The Fed's going to have to take their foot off the gas. Earnings are going to have to kind of hang in there, and I think they are kind of hanging in there. But when it comes to the election, I don't think this is going to be one of those where we're going to get a whole lot of market turmoil around it. The Inflation Act's been passed. We'll go into this. We'll go into this election knowing a little bit more about inflation and how the economy's going, and we'll come out of it probably in the same spot we went into it, which is a murky macro picture.